Hey guys, how are you doing on this fine morning? We have made it to Thursday so quick, it feels like time speeds as we age. Anyways, as promised, today we will continue to part 2 of the 3 video series on how Wall Street prospered from the pandemic recession. I want to thank everyone who showed up yesterday. If you missed that video, I will link it in a pinned comment below. Thank you to all that showed up today and yesterday. We are going to pick up right where we left off after a small and quick recap. I want to thank Amanda Fisher, whose work and due diligence has inspired me to make this video. Before we start, let me quickly state that I am not a financial advisor, and that all content discussed in this channel is simply information gathered that I deem important for people to know, so that they can make informed decisions. All efforts are aimed to better understand the nature of the current market in anticipation of the greatest squeeze in financial history. Let's get started. Yesterday, we talked about how individuals, families and small businesses were impacted by policy from the government. Citing some studies performed by academics, we have data that supports the claim that many of the policies the government implement did help all 3 groups survive through the pandemic, while also allowing for the economy to not crash. However, as many of the restrictions have been lifted, and people are slowly reintegrating back to normalcy, things are still not as they used to be. We have seen many people respond in different ways. Many are avoiding going out due to health concerns, while others have elected to simply stick to the changes they have had to make. Simply put, many are simply not financially adequate to keep up with so much change, given that many of the financial provisions have been lifted off. With other problems like inflation driving the prices of rent and consumer products up by the month, individuals, families and small businesses are finding themselves having to make tough choices on what they have to cut to survive. Every part of the economy has been severely affected, except for Wall Street, which has been insulated from all of these problems. Today we finally get to talk about why it is that Wall Street and its many institutions are having all-time highs, enjoying tremendous success that makes no sense in direct contrast with the rest of the economy. We are going to talk about the stock market and the bond market in particular. As you know, stock prices are determined by the confidence of investors in the potential future earnings of a given company. Though not extremely risky, there is still a chance for stockholders to experience loss if a company they are invested starts to miss projections or experiences some type of failure. In good times, stockholders get compensated through dividends or simply the profit of watching their assets grow over time. One would imagine that with the pandemic ravaging the globe, forcing many businesses to close down and everyone to stay home for months, that the stock markets must have taken a huge hit, and that they should be now slowly moving back up. Well, that has not been the case at all. In fact, quite the opposite happened. The S&P 500 is performing extremely well, with its 5 top companies pretty much leading the rest upwards. Apple, Amazon, Alphabet, Microsoft and Facebook represent around 1/5 of the total market capitalization of the 500 largest firms in the United States equity market. To put things in perspective, all the 500 companies in the S&P 500 represent over 75% of all the value of all equities traded on the stock exchanges. This concentration of the top companies all being in the technology sector has been what allowed them to dominate the stock market in general. We are at a point where the top companies I talked about all outpace entire indexes in gains. Now, the reason why I mentioned all of this is because, as we initially said, stock prices reflect an investor's confidence that the future health of the company will be better than it currently is. With this in mind, it makes sense why technology firms have inspired so much confidence during the pandemic. With people initially quarantined and now preferring to work from home, it makes total sense why investors feel confident in investing in tech sectors that are uniquely suited to benefit from the transition that has taken place. It is not even just work for the individual and families. People are changing the way they shop, with surveys showing 60% growth as of last year in grocery purchases, 45% growth in online over-the-counter medicine and 18% in online consumer electronics purchases. There is a reason why Amazon has had the absolute monster run since 2020. The company reported a 40% growth in earnings on its second quarter of 2020. The growth has made the company decide to convert vacant mall department stores into distribution centers, as many of the company's rivals going out of business since they are unable to compete against the behemoth that is Amazon. Now that I have established some of the facts, let's start diving into why it is exactly that so few companies are able to survive when it seems that everyone else is unable to get enough online traffic. Diving into the core reason takes us back to the government and how its competition policy favors big tech. The Washington Center for Equitable Growth's Director of Competition Policy Michael Cades has noted that weak antitrust laws and courts tend to use unsound economic theories that continuously expose markets to corporate abuses of power, which boosts large corporations' profits and dominance at the very expense of their competitors, workers and consumers. Many practices are placed that allow dominant companies to stifle rivals, even potential ones, which prevents healthy competition on merit and allows incumbents to obtain and exploit market power. Cades made several examples, citing instances where practices were placed that ensured big tech abused their position to eliminate competition. He pointed to when Facebook cut off community entertainment Vine's access to Facebook because they viewed them as a dangerous competitor. He talked about how Amazon's prices proprietary products and services below costs to drive out competitors so they can then monopolize a certain market and then raise prices way above what they should be. He talked about how Apple discriminates against apps that compete with their products, and how Google forces customers into their own content and products over their competitors. In the end, Cades noted that new legislation is needed to enforce agencies' and courts' abilities to bring back balance to antitrust laws. One of the things I have personally seen that also affects consumers is giants buying out all competition. Through the years, we have seen how companies like Disney have devoured pretty much everything that stood in their way. They have been allowed to buy out Marvel, Pixar, Fox, Hulu, ESPN and many others. Microsoft is famous for being another company that loves to buy any up-and-coming start-up or company with relative success. This only hurts the economy because it continues to foster all the power among a very few Wall Street-favored corporations that only know how to devour or destroy others for their own benefit. The policy we have not only allows these things to happen, but actually perpetuate it. There is enough evidence to suggest policymakers actually suppress competition through harmful exclusionary conduct. How can we be a capitalistic society when nobody is allowed to succeed at starting a business and growing it too big without big tech either taking you out by copying your product or service or outright buying you out? Wall Street has made tons of money by funding themselves with shares for these companies, because it affords them huge earnings and the guaranteed return on investment since they have helped these companies take control of policymakers. By helping big tech rid themselves off of competition, they can guarantee most investments to be on their preferred stocks. We recently talked about how ETFs have been surging while the amount of companies in the stock exchange have dropped significantly. There simply is no benefit in going public, especially when Wall Street has found ways to cheat the system to their favor. Moving to the bond market, firms have now found enriching ways by which they can fund themselves with bonds, which for those that don't know are securities issued by a firm paying a pre-established rate of return for a fixed period of time. When you look at some of the figures laid out, you will see that the bond market has become extremely robust, and Wall Street has been the biggest beneficiary of all. Unlike the stock market, the bond market has performed extremely well for all types of companies, not just the ones on top. Trillions of dollars were issued last year and trillions have been issued this year at record numbers. Companies have needed to raise additional money to help feed them while they survive the decrease in revenue brought by the pandemic. Many other companies, without the need for such type of measure, have decided anyways to issue new debt because of the historically low cost of financing. Heck, even Alphabet and Apple borrowed billions of dollars to get in on the opportunity to borrow some debt financing. And it's not just the investment-grade bonds getting high records. Riskier firms have been issuing bonds as well. You might be wondering, but wait, how does any of this make sense? How come they are allowed to borrow so much money while big tech is having major indexes at record highs on the stock markets? Well, the culprit of it all falls back on the Federal Reserve. This is where we get to meet the one and only Jerome Powell and his infinite lack of wisdom. The bond market seized up back in March of last year, but the Federal Reserve made an announcement that it would undertake a number of aggressive measures to boost the economy, including buying bonds and ETFs backed by bonds using funds appropriated under the CARES Act. This very announcement produced a huge grin on every Wall Street executive. It caused markets to rebound and do a full 180, bringing back more confidence in the markets than there was before the pandemic. Jerome Powell noted that the central bank would not run out of ammunition, which in other words means he would be printing money non-stop for Wall Street to not only survive, but make an absolute record killing. As you might imagine, the parties held that night on Wall Street after such a statement must have been absolutely legendary. Little did they know that Jerome Powell is the type of guy to not really think ahead and remember that unlimited printing has very bad consequences for an economy, and that it can literally cause an even market crash that the pandemic could have ever brought. Why do you think the man is changing his stance on a day-to-day in regards to inflation, one of the outcomes of unlimited printing? He doesn't want to shoulder any responsibility for causing this chaos affecting everyone. Among all the individual bond purchases, the Fed has been particularly concentrating on blue-chip companies, which for those that don't know are the well-established corporations with household names. The Fed also helped out riskier companies through their insane number of purchases of ETFs. The reality is that the Fed got in too deep on this, owning over $12 billion as of last year. The effects are extremely profound and show that they are willing to do whatever it is to stabilize corporate credit makers and keep the market afloat. By doing this, Wall Street executives have been cannibalizing a ton of funds and making an absolute killing on their end. They have the Fed essentially working for them, and the Fed has an unlimited printing machine which they are more than happy to keep working for Wall Street. It is absolutely ridiculous that the government let this happen, and it sucks even more that the problem is so out of hand that they cannot stop printing, because if they suddenly did, they could unleash a huge disaster. Again, the only reason why Wall Street and the markets are afloat is because of the confidence brought by the Fed and their unlimited printing machine. It is single-handedly the only reason why we have not gone under yet. If you take this away, a lot of that confidence will disappear into thin air in an instant. I have absolutely no doubt the decisive decision by the Fed saved the economy, but it has gone too far, and with the poor regulatory oversight by the government, this has turned out to be a much worse problem than the pandemic ever was. By trying to save ourselves from the virus and the chaos it brought, the Fed and the government have started something they don't know how to properly address. This is a good point to stop. Tomorrow I will talk about why it is that none of these profits are trickling down to the rest of economy. The whole trickle-down economics is the biggest farce that ever was, as I will show you tomorrow, and there is no evidence to suggest it can work, with this whole issue being the prime example of it. It was a longer video, and a pretty complex one. I hope to have added a wrinkle or two to some of you. I hope you have a good fundamental understanding of why we are where we are. These videos take a lot of time to make, so feel more than encouraged to let me know what you think and to provide any feedback. Thank you all so much for making it to the end. I hope to see you guys a bit later in the day. If you want to support the channel, I have left links in the description for my Patreon if you would like to pledge a monthly support of any amount you want. I also left a PayPal and Cash App link if you want to make a one-time donation. Again, thank you so much for watching. Good luck on the rest of your day and to the moon.